You know, traveling for medical care is stressful enough without having to wrestle with the tax code. Today, we're going to break down the IRS rules for deducting those travel costs, and we'll show you why it's actually way harder than you'd think to get a real tax break. So, let's picture this. You or someone you love needs a specialized surgery, and the absolute best doctor is states away. You're booking flights, a hotel, paying for meals. The million-dollar question is, how much of that can you actually write off on your taxes? All right, so here's our game plan. We're going to start with the biggest barrier you have to clear right off the bat. Then we'll get into the nitty-gritty of transportation, lodging, the super tough rule on meals, what happens when you bring someone to help, and finally, why keeping records is absolutely everything. Okay, before we even start talking about deducting plane tickets or hotel rooms, you have to know about this massive hurdle. And frankly, this is the rule that knocks most people right out of the running before they even start. Here it is. That's the magic number. You can only deduct the part of your total medical expenses, and that's everything, doctor's visits, prescriptions, plus your travel, that goes above and beyond 7.5% of your adjusted gross income. Let's just put that into perspective for a second. If your AGI is $100,000, your first $7,500 of medical expenses gets you, it gets you nothing. Zip. No tax benefit at all. You only start deducting after you've hit that mark. It is a really, really high bar to clear. Okay, so let's say you've managed to clear that huge 7.5% hurdle. Now we can get to the good stuff. And honestly, transportation is probably the most generous part of this whole medical travel deduction thing. Yeah, when it comes to getting from point A to point B, the list of what you can claim is surprisingly long. As long as the trip is, and this is the IRS language, primarily for and essential to medical care, you can deduct the cost. So we're talking flights, Ubers from the airport, even the parking fees at the hospital garage, and the tolls along the way. Now hold on, because this is a big one where people get tripped up. If you drive your own car, you might think, great, I'll just take the standard business mileage rate. No. Look at this gap. For 2025, the medical rate is almost 50 cents lower per mile. So why the giant difference? Well, the IRS's logic goes something like this. You'd be paying for things like your car insurance, your registration, and just general wear and tear anyway, right? So the medical rate is designed to only pay you back for the direct out-of-pocket costs of that specific trip, which is basically just gas and oil. This is a question we get all the time. I mean, if you're traveling after a big surgery, squeezing into an economy seat might be physically impossible. So can you deduct that much, much higher cost of a first-class ticket? Believe it or not, the answer is yes. But, and this is a huge but, it has to be medically necessary. And the key is paperwork. You absolutely need a letter from your doctor that spells out exactly why your medical condition required a lie-flat seat or that extra space. Without that note, forget it. The IRS will almost certainly say you can only deduct what a coach fare would have cost.
All right, let's talk about lodging. And I gotta warn you, this is where the rules get incredibly tight. While your plane ticket might be fully deductible, what you can claim for your hotel is, it's severely limited.
Yep, you are seeing that right. $50. The IRS caps your lodging deduction at a maximum of $50 per night. I mean, in most big cities today, that number isn't just unrealistic, it's almost laughable. There is one small bit of good news here. That $50 cap is per person. So if a doctor says that the patient absolutely needs a companion to travel with them, you can deduct up to $100 a night for the room. But even to claim that $50, your stay has to jump through these 4 hoops. And pay really close attention to number 2. The care has to be from a doctor in a licensed hospital. That means a trip to a fancy wellness retreat or some alternative health clinic, that's probably not going to qualify. And now, for the rule that catches pretty much everyone by surprise. You're away from home, you've got to eat, right? But when it comes to deducting that cost, the IRS has a very clear, very blunt answer. That's it. For medical travel, you can deduct a big, fat 0 for your meals. This is totally different from business travel, where you can deduct 50%. The IRS's logic here is simple. Food is a personal expense, and you would have had to eat anyway, even if you were sitting at home. This table just shows how stark the difference is. The only time your meals become deductible is when they're part of your bill for an inpatient hospital stay. So if you're staying at a hotel and grabbing a bite at the hospital cafeteria, sorry, those costs are on you. And this isn't some new rule. It was decided by the Supreme Court way back in 1962.
So what happens if the patient is just too sick to travel all by themselves? And with all these complicated, picky rules, how on earth do you prove all of your expenses if the IRS comes knocking?
Well, the tax code does recognize that sometimes you need a caregiver. If it's necessary for someone to go with the patient, think a parent with a child or a spouse helping someone after surgery, then that companion's transportation costs, like their plane ticket, are also deductible. Look, with rules this specific and this strict, having meticulous records isn't just a good idea, it's non-negotiable. If you want to survive an audit, you need receipts for everything, a super detailed mileage log if you drive, and, this is critical, letters from the doctor justifying the trip itself, and any of those special things like first-class airfare or a travel companion.
So here's the bottom line. Knowing the rules for deducting medical travel is only half the battle. Without airtight documentation to back up every single claim, that deduction you thought you had could just vanish. So the real question you need to ask yourself isn't just, what can I deduct? It's, what can I prove?